What's up guys, John here. I'm a certified public accountant for over 20 years. I have worked with many successful investors and corporate executives and have seen how they achieve financial freedom by investing in dividend stocks. Today I want to profile 3 of them. Please watch the video until the end so you know what the common theme these stocks all share. When it comes to income investing, many people make the mistake of chasing high yield stocks. In fact, you need to look at the total return. You need to look at the dividend because you're going to make money from dividend and capital growth. So you don't want to have just a lot of dividend and then your capital is shrinking. When you look at the total, it's actually negative. And also, the average S&P 500 company, the average yield is at around 2%. So if you're looking at a stock and the dividend yield is more than 8%, it's considered risky, because how are they going to make so much cash that they could pay out so high of a dividend? Unless they leverage and they borrow more in order to pay dividend. So you're going to look at their financial operation to see how they support that kind of dividend payout. In short, income investor needs safe, stable dividend stock with relatively high yields. So let's look at the first stock. The first one is Verizon. It's a telecommunication company. The dividend yield is 4.2% as of August 30th. It raised the dividend payout for at least 10 consecutive years. That's a very long time. It has lots of cash flow to support the dividend payout. For the 12 months ended June 30th, it paid out $10 billion in dividend, but it generated free cash flow of $15.7 billion. So it is a cash cow. It is a leader in wireless services. And let's also look at some of the financial metrics to understand how they can pay out so much in dividend. The price earning ratio is at 12.8, which I consider reasonable. The net profit margin is at 15%, which is very good. I usually like to see net profit margin at or above 15%. So this fits the bill. The return on equity is at 32%, which is very good. Generally, I want to see over 17%. So this one passed the test also. The price change for the last 26 weeks is 3%, which is not so good, right? You will see like a lot of stock has rebounded since March, but 3%, it's okay, not that great. The earning per share is increasing every year since 2016. So every year you could see the trend, it's growing, which is a very good sign. The revenue is stable for the last 5 years, which means that Verizon is a financially sound, stable company. That's why they're able to pay dividend every year. So the second stock we're going to look at is AbbVie. It's a pharmaceutical giant. The dividend yield right now is at 5%, and it raised the dividend payout for 48 consecutive years. That's amazing. It has strong lineup of best-selling arthritis and cancer drugs, and it also has a strong pipeline of dozens of drugs across various stages of clinical trial. So these are all very good signs. The impact of COVID-19 is actually minimal to its business. And let's look at some of their financial metrics also. The price earning ratio is at 21, which is reasonable. The net margin is at 19%, which is I consider very good because it's over 15%. The return on earning, return over the ROE ratio is 225%. This is excellent. It's way over the 17%. The price change in the last 6 months is 8%, which is not so good, but I'll take that. The earning per share is increasing every year since 2016, and the 2020 earning per share is expected to be double of 2019. So this is a very positive sign. The revenue is increasing for the last 5 years. So again, the financial, it looks very sound and stable. That's why they're able to pay dividend for so many years. The third stock we're going to look at is Altria. It's a tobacco company. The dividend yield is at 7.8%, which is it's amazing. It has lots of cash flow to support the dividend payout. The 3-year dividend growth rate is at 21%. So it maintained the dominant market share position in its category. That's why they're able to do so much business and cranking out all the cash flow. Let's dive into the financial metrics. The net margin is negative 3.5%, so which is not that good, because the 2019 has a loss. That's why the ratio become a negative. The return on equity is also a negative 8.7%, which is not that good. Again, it's attributed to 2019 they have a net loss. The price change for the last 26 weeks is 4%, which is not so good. The earning per share for 2020 is expected to have a very profitable year, and earning per share to grow another 6% for 2021 and 16% for 2022. So we want to look back. 2019 not a good year. 2020 is recovering. The next 2 years it's expected to grow again. And the revenue is stable from 2016 to 2019, but will drop somewhat in 2020. But we'll just make up for controlling some expenses, and that's why they're expected to be profitable. Okay, so I would like to get some feedback from you. Comment below. Let me know which dividend stock do you own. I also do private financial and tax consultation. So for any inquiry, my email is listed in the description section below. I hope you learned something today. If you enjoyed the video like this, please smash the like button and subscribe to my channel. I produce new content every week and I don't want you to miss it. I will see you in my next video.